Welcome back, everybody. Welcome back. This is another intro to Gold Futures 101. All right, in my last video, I touched up on order blocks versus breaker blocks. Today, I want to go over what is liquidity and how to find liquidity, right? So, before I start, I just want you guys to take a screenshot of this. So you never forget it. You could always look back to it. If you ever have any questions, if you forget something, just take a screenshot of this. Always use it as reference, and always look back at it when studying your own charts. Okay, diving right into it. Liquidity is just a shorter term for resting and pending orders, right? What are resting and pending orders? Most of the time, liquidity will be retail traders' stop losses that they have set for their trades. And what do institutions like to do more times than not? They want to gather up as many orders as they possibly can, or stop out as many retail traders as they possibly can in order to fill their bigger orders, in order to push price in the direction that they actually want price to go, or move the markets where they want it to go. Okay, so there's two different forms of liquidity. There's low resistance liquidity and there's high resistance liquidity. All right. Low resistance liquidity is usually found on lower time frames, either the 1 minute, 5 minute, 15 minute, so on and so forth, right? Versus high resistance liquidity is usually found on the higher time frames, 1 hour, 4 hour daily chart. All right. Another form of high resistance liquidity is also going to be found in your session highs and lows, your New York session highs and lows, Asia session highs and lows, as well as your London session highs and lows, okay? So just a quick breakdown of what liquidity looks like, all right? I'm gonna take my tool brush here, all right? Let's say we're in a bearish or a bullish market here, right? Let's say we just see price moving higher and higher, creating higher highs and higher lows, right? Where would you find liquidity? Liquidity will be resting under every single one of these lows, right? So as we're in a bullish market, or as price is moving up, traders usually are hopping into trades within these up moves, right? Where would they put their stop losses? Right below the previous low, right? To protect their trade so they don't risk too much, right? There's also liquidity found at every high point, right? And why is there liquidity at both sides, right? Because when retail traders are trading, usually retail traders are on both sides of the spectrum at the same exact time, right? So as there's buy orders getting filled, there's also sell orders also getting filled, and that's why we see these up and down movements in a bullish market. Same thing with a bearish market, right? So if we see price moving down or moving lower, right, what we're gonna see is we're going to see a bunch of resting liquidity at these highs, as well as resting liquidity at these lower lows, right? So as retail traders are hopping into trades, what do you see, right? If they're going in shorts, they're going to have their stop loss set at previous highs to protect their trade. When retail traders are hopping in buys, looking for reversals, right? They're putting their same stop losses underneath these lows. Same thing in a bullish market is the same thing in a bearish market, okay? So what do hedge funders or big institutions usually like to do, right? What they'll do usually is, let's say they want price to go lower, right? In a bearish market, they want price to inevitably go lower, but they need a place for entries, right? What they'll usually do is they'll stack up all these stop losses and they'll actually push price right through all of them, right? Prior to placing their bigger orders once all the retail traders have been stopped out. And then what they'll do is they'll actually send price right back down in the direction that they originally wanted it to go. Same thing, vice versa, right? If we're in a bullish market and institutions want the market to continue higher, what they'll do is they'll grab as many stop losses as they possibly can, right? Prior to pushing price or entering where they want. Once all these retail traders are now out of the market, they'll buy up all of those orders and they'll push price right back up to where they want it to go, okay? So if you guys want to take a screenshot of that as well, please feel free to do so. All right, these are the easiest ways to explain it. All right, I'm going to dive into real market structure to show you guys in live time how to find them on candlesticks specifically. Okay, let's get rid of these drawings real quick. Okay. So now, diving into the real market, okay? So, like I said, there's a few forms different of resistance or liquidity, right? There's high resistance liquidity and low resistance liquidity, right? So when you're on the 1 hour chart, what are you gonna be mostly looking for? You're gonna be mostly looking for high resistance liquidity points or session highs and lows, right? So what are the different sessions? The different sessions, right? New York session will be anywhere from 9 in the morning till about 5 p.m. Eastern Standard Time, okay? Asia session will start at 6 p.m. or 1800 is what you'll see on your charts, and that will go all the way until about 1:30 or 2 in the morning Eastern Standard Time, okay? And when is London session? London session will open up as Asia session closes, right? London session opens up at 2 in the morning and it will go up until New York session essentially, or about 8 o'clock in the morning, okay? So we always want to make sure we are marking these out so we can defer the differences of Asia sessions, London sessions, as well as New York sessions, because in each one of these individual sessions, there are a bunch of institutional traders, a bunch of retail traders hopping into these markets at different times of the day, right? So obviously during Asia session, on the other side of the world, you have those big institutions as well as any retail traders in the markets across the world. They'll be opening their positions more times than not during Asia session. Same thing with London session, right? Anyone trading in London or in Europe, right? They're usually opening their orders anywhere from 2 in the morning or 2 in the morning to about 8:30 in the morning Eastern Standard Time, and same thing with New York, right? So when New York stock market opens at 9 in the morning, that's when you'll see any type of New York or US retail and institutional traders hopping into the market. So there's 3 different parts of money, right? You could call it 3 different sessions where there's a bunch of money entering within each of these sessions, right? So you want to mark these out. So when you're marking these out, when you're looking for them, it makes it very easy using this vertical line tool, right? Listed right here on the top. Just hit this little arrow, go down to the vertical line. And what you're going to do is you're actually going to mark out every single session, right? So you're going to mark out your Asia session. You're going to mark out your London session. And you're going to mark out your New York session, okay? This makes it very easy to find session highs and lows from previous days or even in live time trading when you're looking at the charts in live time, okay? So on the 1 hour chart, very easy to find these opening ranges, right? So you're gonna find 1800 first, you're gonna find 2 in the morning second, and you're going to find 9 a.m. last, okay? So mark out all 3 of these, and these are going to be your separate sessions, right? So then when you dive down into a smaller time frame, it is much easier to find session highs and lows, right? So what's the first thing you notice when looking at Asia session in this category, right? So what you see is a low, right? Which in Asia session, I like to mark the lows and highs in red to keep them organized. And then we also see this high point right here prior to London session opening, all right? What do we notice as soon as London session opens? We get a high resistance liquidity sweep prior to a nice rejection into a 15-minute fair value gap. So this is just how you stay up to date with how price is moving, right? To see how it's responding, how it's reacting to certain levels, right? So now that New York or Asia session or Asia high has been swept, right? What is now created when this 15-minute fair value gap is tapped into? A new low, but a London session low. So this is actually going to be your high resistance liquidity for this specific session moving forward as well, okay? What else do you see? You see a high point right before London close. What would that be considered? That would be considered your London high, right? So you mark those out in blue, Asia session highs and lows marked out in red, just so you could keep everything organized, so you don't forget and you don't get confused, right? Getting into New York session, what do we see? We see as soon as New York session opens, we get a New York low, and then we get a New York high in the afternoon session around 2:15 in the afternoon, okay? Like I said, New York session closes around 5 p.m. A lot of future sessions will close around 4:30, depending on what prop firm you're using. A lot of prop firms don't like to have any trades open after 4:15 p.m. Eastern Standard Time, so just be wary of that when you're trading. A lot of the times, they won't let you carry over any New York session trades into Asia session. The only time they'll let you carry over trades is if you were to make an Asian session trade or an Asian session entry and then carry it overnight into the next morning. That is completely okay, because technically the daily chart will start at 1800 or the beginning of Asia session, okay? So again, once New York session closes, that's technically the last trading session of the day. So a lot of prop firms will not let you carry over any type of trades that were set in New York session if you're looking to carry them over into the following Asia session, okay? So just keep that in mind when you're trading. Be wary of that when looking for entries and when to hold versus when not to hold, right? Of course, when you're on a live account, you could hold however long you want. Depending on what brokerage you're using, they will charge you swap fees, all right? Some brokerages charge more in swap fees than others. And what's a swap fee? Swap fee is essentially just a brokerage keeping your position open or alive during after hours or through different sessions, through multiple days, maybe weeks if you're a swing trader, so on and so forth, right? So you definitely do want to keep that in mind when looking to hold positions through sessions and carry over trades overnight, okay? So once you have your high resistance liquidity marked out, you have all your New York highs and lows marked out, you have your London session highs and lows marked out, and your Asia session highs and lows marked out, what you're gonna do is you're gonna dive a little further down into a smaller time frame, maybe a 1 minute, maybe even a 5 minute, right? Just to see what kind of other points of interest there might be, right? So starting in Asia session, anytime you see a high or a low, that would be resting liquidity, right? So what you could do is you could actually mark these out, right? You can mark all your lows, all your highs out, and these will be considered your relative low resistance liquidity draws, okay? So why are these lower resistance liquidity draws, right? Because these are where retail traders are hopping in. These are where retail traders are having their orders placed or their stop losses placed, right? So those will be much easier for price to come down or come up, sweep out, and then have big institution orders filled prior to continuing price in whatever direction institutions and market makers want it to go, okay? So difference between low resistance and high resistance liquidity. What is really the difference? What makes these two different, right? When you're thinking about high resistance liquidity versus low resistance liquidity, when you see a high resistance liquidity pool swept out, usually a lot more orders are getting filled and bigger orders are getting filled. So that means a lot more movement will happen in price or in market structure rather than if a lower resistance liquidity had been swept out, all right? So I'm gonna try to find you guys a quick example of that, all right? So here, you have a perfect example right here on the 5-minute chart, right? You have a low resistance liquidity high created, okay? And you also have a low resistance low created as well, right? So what happens when price comes up, sweeps out this internal high as well as this internal high, right? You have a bunch of stacked low resistance highs here. Once price sweeps out all three of these, and it actually did come in and sweep this one as well. So that's actually 4 stages of low resistance liquidity all stacked up. Price will, more times than not, especially on the gold market, if you see stacked draws on liquidity, low resistance liquidity stacked like this, more times than not, price will want to come up, sweep all of these, build as many, plug in as many orders as possible for institutions in order to send price right back down to where they want it to go, right? So as you can see, price makes a couple highs, it makes a new low, price comes up, sweeps all those low resistance highs, and then shoots right back down to that low resistance low, right? Why is this important? Because liquidity is what moves the market, right? If there is no liquidity to pull, the markets will not move. And that's when you'll see a bunch of sideways price action or barcoding price action, where price is just moving side to side, stuck in a little zone, not really moving up or down, okay? So why is this important? Because a lot of the times retail traders will be liquidity and to those bigger traders, right? To hedge funders, to the banks, to those market makers. Those market makers are watching you place those orders live time, and what they're doing is they're looking to stop hunt, is what I call it. And what I mean by stop hunt is they will actually move price in the direction of your stop losses. And if they see more stop losses at a certain level of interest, what they'll do more times than not is they'll push price right through that level, stopping out all retail traders in order to fill as much positions as they possibly can prior to moving price out, right? So this is another great example right here. Let me get rid of these lines so it's a little bit easier for you guys to understand and see as I mark it out, right? So what do we see here? We see a bunch of stacked low resistance lows, right? And what do we see? We see price come down, sweep all 3 of these low resistance lows, and then swinging price right back up during pre-market of New York session on this specific day, right? So instead of sweeping out one, they'll sweep out anything that's relative equally low, right? So what do we call these? These are stacked lows or relative equal lows. Why? Because they are so close together. If in the gold markets, more times than not, like I said, gold will want to sweep out more traders, as many traders, retail traders, as they possibly can prior to building up their orders, placing as many orders as they possibly can fill prior to moving price in the direction that they want to go, as we see here, right? So again, if there's no liquidity getting swept like we see here, why do we see a bunch of sideways price action here, right? Because there's no highs getting taken and there's no lows getting taken, right? But what happens once a low finally does get taken, right? We sweep these lows and then price runs and takes out all of these highs that were just created on this little downtrend here, right? And as you can see, you can mark them out too, right? Just so you can see in live time, right? You have a low, you have another low, stacked lows. Once again, you have another low here. Once price comes out, sweeps all of these lows out, that's when big institutions will hop in the market with huge orders filling, and then they'll come back up and they will sweep out all of these relative equal highs that were just created on the initial move down to sweep out these previous lows, right? So why are these important? Because we want to try to get involved with the big time players. We want to trade with the market makers. We don't want to trade blindly. We don't want to trade just normal price action. We want to find where liquidity lies so we can use that to our advantage. If you don't know where liquidity is, I'm sorry to break it to you, but you are liquidity, right? So what was the biggest thing that I had to do in order to really learn where liquidity is, right? If I was thinking about taking a trade during New York session, right? And my mentor is the one that told me this growing when I was in my early stages. He said, instead of placing an actual trade, why don't you place a fake trade or a paper trade and just set your stop loss as you normally would, right? What do you notice? More times than not, your stop loss will actually get touched and then price will run into your take profit margin, right? So what he did tell me was take a breather, place a paper trade, wait for your stop loss to get hit, and if price action is still moving in the direction that you want to go, or if it's still giving you your confluences the way you want them to, enter your trade, your real trade, once your stop loss is hit, and target the same take profit as you were originally, and watch how much more successful your trades play out, right? Again, once you look for a trade, enter a paper trade or a fake trade. So don't enter an actual trade using real money or putting any money at risk, right? Basically what you want to do is you want to set a long or a short position, right? So let's say we're setting up a long position here, right? We have our stop losses, below these lows. Wait for these lows to get swept and then place your real trade there, targeting your same high or your same low for your take profit, right? And as you could see, is once the original stop loss was hit, it never came back to revisit. It never wanted to push lower than where it did originally, and your trade would have been safe the entire time until you were able to take profits wherever you wanted at any one of these relative equal highs or any one of these points of low resistance liquidity, right? So just to backtrack really quick for you guys. Where are we at? So what is liquidity? Liquidity is a shorter term for resting and or pending orders, all right? Most of the time, liquidity will be retail trader stop losses in the market that they had set for their trades. And why is this important? Because big institutions will want to, more times than not, come out, sweep out as many retail traders as they can so they could gather up as many orders as they possibly can in order to push price in the direction that they want to go. More times than not, institutions and market makers want retail traders to fail as many times as they possibly can, right? So that's why it's important to make smart trades, smart money moves, and to really follow the market structure and what it is giving you, right? Always wait for a manipulation leg. All those manipulation legs are telling you is institutions are hopping into the market and they're looking to sweep out a bunch of retail traders so they could get as many orders filled as they possibly can in order to move price in the direction that they want it to go, right? So what happens when you see a big move in the market? More times than not, it was made by market makers and a bunch of big institutions hopped in at the same exact time, stopping out a bunch of retail traders, filling up their orders so they could capitalize on as much money as they possibly can on their positions and on their trades, right? Again, we want to trade with the institutions. We want to trade with the market makers. We do not want to trade against them because 9 times out of 10, your stop loss will get hit and you will be very upset with yourself because essentially after watching this video, you'll know better, right? So always sit on your hands, always be patient, never force a trade, and always let the market come to you. Don't have a daily bias in the morning, right? When you open your charts and you see and if you see market dumping, don't automatically assume that it's going to continue dumping all day. More times than not, it's dumping because institutions want to stop out any type of retail buyer that's been in the market for the last couple of days so they could fill out as many buy orders as they can before they push price right back up into the direction that they want it to go. All right. If you guys have any questions, please feel free to leave them down in the comment box. I'll leave my Instagram handle in the description, so you could always DM me if you want to keep it more private. I have no problem with that. I will make sure to get back to every single one of you as soon as I possibly can. I appreciate you all for all of your support since day one. I love you guys, each and every one of you. Till next time, peace.